Yet again, I am your host in today's video presentation. My name is Wando Franklin, lead tutor, chief executive officer, and the pioneer of FCO Accountants Tuition Center. In today's video, I'm going to discuss the IFRS 2 cash settled share-based payment. Cash settled share-based payment. This is a scheme where employees are promised to be paid cash, which is measured in relation with the fair value of the shares at each reporting date. So when the employees exercise their right now, we measure the shares in relation to the intrinsic value. Where intrinsic value is not given, it can be determined. Intrinsic value is equal to market value of shares less the strike price. Strike price or exercise price. So intrinsic value is equal to abbreviation. Intrinsic value is equal to market value of shares less the strike price or exercise price. That will be the intrinsic value. But in this question, the intrinsic value is given. So intrinsic value is used when the employees exercise their right. Now, the most important thing to remember here is that the CSARs, that is cash share appreciation rights, before they are exercised, they are measured at the fair value at each reporting date, taking into account the number of employees who are expected to exercise their right. So what does that mean? It means at each reporting date, you determine the expected number of employees to leave the employment. And the expected number of employees to leave the employment should cover the vesting period. So I have a question here that we are going to look at. Activity number 2, cash settled share-based payment. On 1 January 20X4, an entity grants 100 cash share appreciation rights to each of its 500 employees on condition that the employees remain in its employment for the next 2 years. The SARs vests on 31st December 20X5 and may be exercised at any time up to 31st December 20X6. The fair value of each SARs at the grant date is 7.4. Care must be taken. When we are dealing with the SARs, we do not use the fair value of shares at the grant date. We don't use, take note, we use the fair value of SARs at each reporting date. So in this question, we can determine, we can come up with a table. We have years. Then we have the P&L. We have the adjustment column. We have the liability column. When the employees exercise their right, it's not a liability. because they'll be paid. So now at 31st December X4, we have 550 employees have left in 20X4, but the number of employees expected to leave should cover the 2 years. So now estimated further employees to leave 60. So that covers 2 years because that is the vesting period. So out of 500, 110 have left. So these, they are getting 100 shares. Multiply by the fair value at the reporting date, which is 8. Divide by, you spread them. Divide by 2, multiply by 1. So there we have 156. In the P&L, that should be the staff costs. It should be in the statement of financial position, that should be liability because they have not yet exercised. So there's a liability. And at 31st December X5, we have here, we have 20X5, 100 employees have exercised. So we say exercised. A 100 employees have exercised. They'll get 100 shares at the intrinsic value 8.10. The intrinsic value is this. So these, they have exercised, and therefore there is no liability. It comes under adjustment, 81,000. In the same year, not yet exercised, that is 20X, this is 20X5. In the same year, not yet exercised, not yet exercised. Not yet exercised, we had 500 employees, less those who have actually left. 50 plus 50, that is 100. Less those who have exercised, 100. Multiply by the fair value at the reporting date, 8.5. There they will be a liability, 255. The increase from 156,000 to 255,000, that is 99, comes here. So this you add. The total will go to the P&L under staff costs, 180. Then in 20X6 December. So there, now the remainder have exercised. Exercised, that is 300 employees, multiply by 100 shares, multiply by the intrinsic value, which is 9. These have exercised, so they'll go under the adjustment, which is 270. So now they are 0. there is no liability. So now the liability has reduced from 255,000 to 0. So there will be a reduction here, since that is a reduction. So the amount to charge to P&L will be 15,000. So that's how you handle this type of a question. So this topic is relevant to ACCA students under strategic business reporting, also under CA 3.1, ZICA students. Yet again, I want just to remind our viewers again to ask questions relating to this topic in the chat box. All the questions will be addressed depending on the availability of time. Also, to make comments in the chat box, all the comments will be attended to in order to improve our delivery. Yet again, on behalf of FCO Accountants Tuition Center, I want to encourage everyone to continue supporting us. And I wish to say thank you very much for supporting us. May Jehovah Lord bless you beyond measure. Thank you.